Welcome to The Explainer. Today, we're digging into a really fascinating question. Why do so many people who actively trade stocks actually end up doing worse than the market? We're going to uncover the hidden psychological traps that could be costing you, or someone you know, a lot of money. And it all kicks off with some pretty surprising numbers.
All right, just take a look at this chart. It comes from a huge study by two researchers, Barbara and Odian, who tracked the accounts of over 66,000 households. And the results are, well, they're stunning. The folks who were trading the most, they managed an 11.4% return per year, but the market itself did 17.9%. That's a massive gap. All that frantic buying and selling wasn't just not helping, it was actively hurting their bottom line.
You know, this isn't some new discovery. The legendary investor Benjamin Graham absolutely nailed it decades ago. He figured out that the biggest thing standing in the way of our own success isn't some complicated market force. It's us, our own behavior getting in the way.
So, how are we going to tackle this? We've got 5 stops on our journey today. First, we'll look at the hard data that shows how trading can be hazardous to your wealth. Then, we're going to dive deep into our own psychology, the investor's inner demons. After that, we'll talk about the classic trap of chasing yesterday's winners. And we'll wrap up by looking at a better way, building wealth instead of chasing returns. And we'll even rethink a scary word, leverage.
Okay, first section. Let's really dig into the evidence from that massive study. The data here is frankly eye-opening.
Now here's what's so interesting. When you look closer, the study found that the problem wasn't that these folks were bad at picking stocks. Nope. Before you factor in costs, their picks were actually pretty solid. The real problem was the constant churn. The average household was turning over more than 75% of its entire portfolio every single year. And for that group of the most active traders, it was just off the charts. We're talking more than 250% turnover. I mean, think about that. That's like selling and replacing everything you own more than twice a year. Every one of those trades comes with costs, commissions, spreads, and all those little fees just ate away at their returns.
So let's be super clear on this. The key takeaway is that the wealth destruction wasn't coming from bad ideas. It was coming from the behavior of trading too much. And what fuels that behavior? More often than not, it's overconfidence, this deep-seated belief that we're smarter than the market.
That brings us right to the next big question. Why do we do this? Let's talk about the psychology behind these bad decisions. It's time to meet the investor's inner demons.
There are a few major culprits here, and they're probably going to sound familiar. We've got overconfidence, which we just touched on. Then there's its very persuasive cousin, FOMO, the fear of missing out. That's that pit in your stomach when you see some stock going to the moon and you're not on board. And finally, there's a really sneaky one, escalation of commitment.
So what is escalation of commitment? It's our tendency to double down on a losing bet. It's that classic throwing good money after bad scenario. And the crazy thing is, we're not doing it because we have some new information that things will get better. We're doing it to justify our original decision, basically to avoid the pain of admitting we were wrong. And this isn't just an investing problem. This quote shows how powerful this bias can be. It's from a memo written way back in 1965 by a diplomat named George Ball. He was warning President Johnson about getting deeper into the Vietnam War. He basically predicted that once the costs started to mount, it would create a psychological trap, making it almost impossible to back out. That is the exact same mental trap that makes an investor cling to a stock that's tanking.
Okay, so these internal biases, our overconfidence, our FOMO, our stubborn commitment to bad ideas, they make us the perfect victims for a very common external trap, and that is the trap of chasing yesterday's winners.
Oh, we have all felt this. You see a fund or a stock that's just had an amazing year, and you get this incredible urge to jump in. It's called performance chasing. And sadly, it's one of the most reliable ways to underperform. Why? Because you're almost always buying after the best returns have already happened. You're buying high.
And here's the really cruel twist. A fund's very own success can lead to its downfall. It's something called the capacity death spiral. Here's how it works. A fund does great. That success attracts a tidal wave of new money. But now the manager is flooded with cash and has to start buying stocks that are maybe not their best ideas just to invest all that money. The original winning strategy gets diluted, and the returns for all the people who showed up late, well, they get crushed.
This whole dangerous cycle is fueled by what's known as the wealth illusion. It's when we start to mistake a rising stock price for actual, real wealth. We forget that a stock is just a claim check on a real company, a company with factories and products and people. When we get obsessed with that price tag and lose sight of the real value underneath, well, that's when speculative bubbles are born.
So, is there an antidote? How do we break free from these destructive cycles? Yes, there is, but it requires a big shift in our thinking, away from chasing those quick, flashy returns and toward the steady, disciplined process of creating real wealth over the long term.
When you boil it down, it's really two completely different games. Wealth creation is like running a marathon. It's patient, it's diversified, it's all about letting compounding work its magic over time. Return chasing, that's a 100-meter dash. It's impulsive, it's concentrated, and it's basically just speculation.
So, what does this actually look like day to day? It's about putting a system in place that protects you from your worst impulses. It means you diversify your portfolio so you're not tempted by every hot stock that comes along. It means you set clear, long-term goals that act as your anchor. And you regularly rebalance your portfolio, which forces you to stick to your discipline instead of just riding the latest emotional wave.
All right, let's talk about a word that often gets a bad rap: leverage. Most people think it's just pure risk, but when you use it correctly, it can actually be a smart part of a wealth creation strategy.
See, leverage on its own isn't the villain here. The danger comes when you mix it with a few other toxic ingredients. A good way to remember this is the acronym LICE. That's when you have high leverage combined with illiquidity, concentration, or just plain excessive size. That is when a useful financial tool turns into a weapon of mass destruction for your portfolio.
Look at these two examples. They really show the difference. On one hand, you have reckless leverage, like betting the farm on a few speculative stocks. A small drop, and poof, you're wiped out. But on the other hand, you have defensive leverage. This is where you use a small amount of leverage to hold a more diversified portfolio, a mix of stocks, bonds, and other things. It can actually make your overall strategy more stable, not less.
So at the end of the day, leverage is just a tool. Think of it like a power saw. In the hands of a skilled carpenter, it's incredibly useful. In the hands of someone who doesn't know what they're doing, it's incredibly dangerous. The question should never be, is leverage bad, but how is this leverage being used?
Okay, let's bring it all home. What are the big things to remember? Number 1, frequent trading is hazardous to your wealth. Number 2, our own psychological biases are often our worst enemy. 3, chasing yesterday's hot stock is a losing game. The solution? We need to shift our focus from return chasing to real wealth creation. And finally, learn to use financial tools like leverage as a defensive tool, not a reckless gamble.
And that leaves us with one final, very important question we all need to ask ourselves. When you look at your own investing, are you playing the long game to patiently build real wealth, or are you just looking for the short-term thrill of entertainment? The answer to that question might just change everything.